Welcome back. Let's go through our last example, which is when we sell a bond with a premium. Okay, so bond C is issued at a premium. How would we know that? Well, we know that because the contract rate is greater than the market interest rate. We also know that the issue price is over 100. And those two things tip us off that we're selling a bond at a premium. Contract interest rate is greater than the market interest rate, and the issue price is greater than 100. All right, so let's start doing some calculations to get ready to do our journal entries. So first thing we want to do is calculate the cash received at issuance. And if you remember, that's going to be, let me go over here, our par value times our issue price stated as a percentage. So times 102%, which would also be 1.02. So let me do that calculation. Par value times 1.02. So we're going to issue our bond for $10,200. That's the amount of cash we're going to receive. Okay, so here, calculate the discount, and that should be the premium. Just get that fixed up. So to calculate our premium, that's going to be our cash received, which is $10,200 minus our par value of $10,000. And when I do that calculation, I find out that my premium is $200. Okay, then I'm going to calculate my premium amortization. You can see that I'm trying to recycle worksheets here and not updating them. It's all right though. You guys will give me a little break on that. All right, so to calculate our premium amortization, we're going to take the premium and divide it by the interest payment periods, which is going to be 8 periods. Okay, and we get that because up here we know 4 years, and we're paying semi-annual interest times 2 times a year equals 8 payments. Okay, so then when I do that, it's going to be 200 divided by 8. So every time we make an interest payment, we are going to amortize our premium, $25. And then by the time we've made all 8 payments, our premium will be 0. All right, so let's calculate our interest payment. So if we remember, that's our par value of $10,000 times our interest rate of 11% or 0.11 times 180 divided by 360. Remember, we're doing 180 divided by 360 because we're paying twice a year. If we were only paying once a year, we wouldn't have to add that part, but we're paying twice a year, semi-annual interest payments 2 times a year. All right, so let me do my calculation here. So par value times our interest rate times 180 divided by 360. So our interest payment, twice a year, we're going to pay out cash of $550. Then to calculate our interest expense, remember when we have a premium, it's going to be our interest payment of $550 minus our premium amortization, 25. So that's going to be 550 minus 25, or 525 will be our interest expense. Okay, we have our calculations. Let's go through and do our journal entries. So we are going to debit when we issue the bond and we get our cash. So we like getting cash. We're going to debit cash for $10,200. That's the cash we receive at issuance. We are going to credit our premium, which is $200. And we're going to credit bonds payable for par value. Remember, every time we touch the bonds payable account, it's always at par value. Debits of $10,200, credits of $10,200. So we are happy little accountants. All right, let's book the journal for our semi-annual interest payment. We're going to start by debiting interest expense. And we said that was $525. We are going to debit the premium for the amortization. Remember, we're debiting it because we originally credited it, and we want to reduce that premium down to zero by debiting it for $25 each period. Then we are going to credit cash, because when we make our interest payment, we do need to pay cash. We said our interest payment was $550. Debits are $550, credits of $550, and we are happy accountants. Okay. Then we are going to go down and do the journal at retirement. This journal is the same regardless of whether we are issuing a bond at par, with a discount, or with a premium. We are always going to debit bonds payable and credit cash for par value at retirement. So we're going to debit bonds payable for par value. And we are going to credit cash par value. And that concludes our example of issuing a bond at a premium. And that concludes our example for bonds. Your worksheet should be all filled out. So at this point, remember discussion questions and doing the homework. And if you have any questions, let me know. Feel free to come to my office hours, and that'll do it. All right, have a good one, you guys.